Hello and a very warm welcome to Boardroom Talk. I'm Alec Hogg and it's a privilege to have you with us. Today we're taking a rational second level look at three heavyweights that sit right inside the BizNews portfolios, the Ricardo portfolios that are run through Easy Equities. And the reason for that, if you haven't yet stumbled across them, is that Easy allows you to put your amount of money in and then allocate the shareholdings fractionally. So if you've got 500 Rand a month that you want to invest, you can put it into that Ricardo ZAR basket, South African Rand, ZAR, and it will divide the 500 Rand up into the stocks that we have in that basket. Similarly for the Ricardo US portfolio. It really works in a way that gives you the benefits of Rand cost averaging, but on the other hand, also allows you to invest in high quality shares and some interesting turnaround options that we have in the portfolio. And of course, apart from your monthly webinar, interactive webinar, I have stories like this where I'll pick up with you on exactly what's going on. And today we've got, as mentioned earlier, three heavyweights that are inside the portfolios, two in South Africa and one in our US portfolio. We've got fresh numbers and strategic new moves from Capitec, Chubb and Remgro, all coming out in the last 24 hours. As investors, it's incredibly easy to get swept up in the noise of the daily news cycle, but here at Boardroom Talk, we like to peel back the layers. We look for the signal. We want to understand not just the headlines, but the underlying mechanics of the businesses that we are co-owners of. And that's what you are. When you have a share, when you buy a share, you're a co-owner of that company. We need to look at the good, the bad, and the slightly uncomfortable. So here's a set of numbers that I've really been waiting for. The banking phenomenon that is Capitec, for two reasons. Tsepo Malelwe, who you may know is the only outside shareholder, small shareholder, but an outside shareholder in BizNews, is the man behind Lebashe. And Lebashe in the past week announced that it has reduced its shareholding in Capitec. I spoke to Tsepo and he explained that this was to do with the derivative structures that tend to always accompany these kind of large shareholdings. And it sounded, he didn't go into a lot of detail, but he did say, and then issued a statement actually afterwards to say that Lebashe has lost none of its huge confidence in Capitec, and the sale from down from about 7% to just under 4% in the equity that it holds of Capitec is not a reflection on the management. So that's good. That's part one. Part two, I was waiting for this as well because Gerrie Fourie, the longtime chief executive of Capitec, is now out of the picture, and we have a new team that's taken over. So it would be, I suppose, instructive to see whether there have been some strategic moves on that side. I hear, and I'm not sure how strongly we can take this, but I hear that Capitec is lining up to take on the UK market. Now, this is something very interesting because I had conversations with Gerrie while I was in London. This is 10 years ago. And he would visit there for the various investment roadshows, and we'd always make a point of having a cup of tea or maybe even breakfast. And I quizzed him on this once and saying that the UK banking scene is really populated by a lot of mediocre. And I know this because of what I was doing there. I was actually trying to open bank accounts and trying to deal with people like HSBC and Lloyds. And my goodness, they are very poor when you're used to South African banking, and very expensive as well. And my suggestion to him was, why don't you come here? Why don't you come to this market? And his response was, no, I can't. We looked at it, but there is this business called Metro Bank, and they do things fantastically well. At the time, Metro Bank was flying. Share price was over £30, and that was largely because an American banker who'd started a big bank in America had gone over to the UK, started the very first high street bank in the UK in decades, Metro Bank, and was running it with all the enthusiasm that you'd expect of a new entrant. Unfortunately, he got caught up in a scandal. His wife was given the contracts by Metro Bank to put together their branches, and this turned into something that just went overboard. And the suggestion was, well, if you can play fast and loose with that kind of governance, what else are you playing fast and loose with? And indeed, when people started digging, they found in Metro Bank that it wasn't everything that it was cut up to be. But the point of, and Metro Bank's share price dropped all the way from £30 to under £1. In fact, at one point in time, it looked like they were going to go bankrupt. They're still around. I've closed my account there long ago. Well, closed BizNews' account there long ago. But it is, unfortunately, a company that had a really good model and was let down by its governance and by those who were driving it. But Harry Fourie said, he admitted that the UK was really ripe for a business like his, like Capitec, or indeed like Metro Bank, and that at some point in time it would make sense to go there. And my various sources from various areas are saying this is something that's now being very seriously looked at. And it is ironic because Capitec going into the UK with its model would coincide with FirstRand coming out of the UK after it got hammered by regulations there to do with the motor trade, in essence, the sale. It owned a business called Motor Novo that was selling guarantees or policies, insurance policies, and the financing structures that were implemented with the sales to motor vehicle agents. And now the regulators have looked at this and they don't like all of this. And FirstRand has it's just given up. It said no. The fines that are being charged to it are way out of kilter with reality, and rather they don't want to play there anymore. But that's not the market that Capitec would be going into in the UK, and it does look like a market that is available to it. Anyway, but let's have a look at those financial results that were released today, and you've got to compliment Capitec. They've come out with an annual report. What are we now? 22nd of April, and we're talking about a February year end. Here it is, the full annual report of hundreds of pages, and the numbers and the figures are good. So the tech is good, the reporting is good, the information systems are as good as they have always been at Capitec, and the headline earnings for the year ended February grew by a phenomenal 23%. The number is 16.8 billion rand. That's proper money. And even in pounds, it's a lot of money. So if they decide to go and play around a little bit more in pounds, it wouldn't surprise me. It's a business that's achieving a return on equity of 31%. And for a bank of its size, those numbers that traditional legacy banks strive towards and will be looking at with deep envy. The legacy banks, if they can get to 15 to 20%, okay, FirstRand's a little bit higher, but ABSA's really striving for 15%. And here you have Capitec with a return on equity of 31%. In other words, the money you put in the business, that's your equity. How much does that generate for you? Well done, Capitec, on that score. Those are really phenomenal numbers. But as rational investors, we have to ask, where's the growth coming from? And what are the risks? Because when you get excessive growth, usually there's excessive risk to go along with it. Well, the good news from Capitec is that it's morphing. It's no longer an unsecured micro lender, which is where it started life. Net transaction and commission income, including what they call value-added services and Capitec Connect, grew by 16%. And they're now at over 20 billion rand in the year. The active client base has swelled to nearly 26 million people. I kind of got to blink at that because I remember seeing some data coming out recently where South Africa's official population is somewhere in the 60 millions, but the analyst who was suggesting this said if you look at what the cell phone companies are telling you, then it's more like 75 million, which would suggest we have a lot of unregistered illegals in our country, which would, of course, make sense given the appeal of South Africa relative to other parts of sub-Saharan Africa. But to have 26 million people, not bank accounts, people on Capitec's books would also reinforce that. Because as good as they are, it's not half the population. Because take out the kids and the youngsters who wouldn't have bank accounts yet. It's not over half the population who would be banking with them. There are lots of other banks as well. So perhaps that true population rate for South Africa of 75 million is probably closer to the mark. Anyway, it is what it is. But let's look at what they're doing with this. And the reality is that Capitec is monetizing this massive ecosystem beautifully. Net insurance income jumped by 38% to over 5 billion rand. By shifting policies onto their own Capitec Life license, they're keeping that money in-house as well. And of course the profit margins too. But, and here is where we apply Howard Marks's second level thinking. The lending environment is getting tougher. The macroeconomic pressure is showing in South Africa. We saw this at the BizNews conference. There was a lot of good news being tempered by a fair degree of skepticism. Good news in that we've got all this potential and we are moving in the right direction and things are improving slowly. But the skepticism coming back and saying, ooh, but you're still sitting in a country with massive unemployment rate, high crime rates, big problems in municipalities and so on. So we've got to apply second level thinking and a good dollop, although we are rational optimists, a good dollop of skepticism when we have a look at things. And Capitec included in that. The net credit impairment charge on loans and advances, what that means is the bad debts. So in other words, I worked in banking for a few years at a very senior position. And what we used to look at was to try and reduce the bad debts as much as possible, because a bank is it's a boxing match, if you like, between the marketing department who just want to put more business on the books and the credit department who want to keep the business off the books, because the more you put on, by definition, the more you're going to lose in bad debts, and they don't like losing bad debts. And you have that very healthy tension between the two. And if marketing takes over, your bad debts balloon. If credit takes over, you don't grow your book. So you have these two, this balancing force. And as far as Capitec's concerned, their net credit impairment, their bad debt charge rose 21% in the past year. And the annualized credit loss ratio, which is the other number that is looked at very carefully. Now, the legacy banks would be panicking if it was over 1.5%. Capitec's is up to 8.1% from last year's 7.5%. So it's gone up as well. So that's the one part that you've got to pause a little bit. But Capitec's always had a higher credit loss ratio than the other banks, and it's had a better return on equity because it charges higher interest rates to the high risk people. You have high risk if you're known for not repaying your loans. Well, the banks are going to charge you more than somebody who's been very good at servicing their debt, never missing a payment, and so on. It's just the reality of the world. It's not because they don't like you. They don't care what you are. They just want to make sure that your risk is correctly priced. And if we dig deeper into the document, and this is the annual report that came out today, this morning, we see that business banking, the new operation, the new bright and shiny thing in the Capitec firmament. Its credit loss ratio rose to 2.4% from 1.7%. Now, does that tell you that they're starting to take on riskier businesses, or are they just more conservative in writing off bad or doubtful debts? They say, though, that in the numbers, that it's partly due to a higher portion of scored unsecured loans. So what they do is someone will come in there and say, I want to borrow 100,000 Rand, but I've got no security to give you. In other words, unsecured. And then you'd go through their track record and you would score them accordingly and say, okay, we're going to charge you prime plus 6%, say, but on the fact that because it's an unsecured and we can't score you high because you're, say, a relatively new business, you've got no security for us, well, we're then going to keep more in reserves against it in the credit loss ratios. And some of that obviously was needed. But the real pain point sits offshore in this set of results with the business called AvaFin, the international online consumer lending business. AvaFin's credit loss ratio surged to an eye-watering 53.2%, up from 42.6%. Those are big numbers. The Capitec management noted that higher rolls into arrears were occurring in Mexico, Spain, and Czechia, which forced them to tighten their granting criteria. And clearly, they are a little concerned about having to write off more of those loans, hence the very high credit loss ratio. So what's the takeaway on Capitec? Well, the core South African transactional and insurance franchise is an absolute cash machine, but management's having to navigate a very treacherous credit cycle, particularly in the subprime European and emerging market ventures. And that's why I'm thinking they haven't done that great in the emerging markets, and Mexico, Spain, and Czechia would qualify there, that their franchise works so well in the first world. And you're looking at a UK where the transactional opportunity is just got to be very high. And who knows? Well, let's listen. Let's see. We hold the stock because of their incredible operational discipline, but we are watching that credit loss ratio like a hawk. So let's cross the Atlantic now and have a look at Chubb. Evan Greenberg's global insurance titan last night reported its first quarter results for 2026. And quite frankly, the operating performance here is staggering. I was put onto Chubb through Berkshire Hathaway, Warren Buffett's company. And if you consider that the biggest part of Berkshire Hathaway is their reinsurance business, and that Warren just loved that side of the business, if anybody knows insurance and where the best buys are in insurance, well, it would be Berkshire Hathaway. So Chubb's a big one in their portfolio, a stock that they've been buying, and that was good enough for me. And I'm delighted that the quarterly results reaffirm that. Chubb is in our BizNews Ricardo US portfolio. So if you're putting your $500 or $1,000 or whatever it is you're doing per month, a proportion of that is going into Chubb to make you an even bigger co-owner as we go forward. Well, detailed in their first quarter release from Chubb was the reporting of core operating income of $2.69 billion US. Makes our guys look tiny, doesn't it? You multiply that by 16, and that's up 80% in the year. Well, compared with the first quarter of last year, 80% core operating income. That's the number that these companies look at. The property and casualty combined ratio came in at an exceptional 84%. I'm not going to go into too much detail on that, but for those who are new to insurance metrics, anything under 100 means that the company is making underwriting profit before they invest the premiums. 84 is a masterclass in underwriting discipline. And what is underwriting? Well, if I go to the insurance company and I say I want to insure my car against having an accident, and the insurance company will look at me and then will price it accordingly and will charge me, say, $100 a month for it. And you add that all into one big pool, if they are able to pay out less than the net income that they're getting on all those $100, then they make an underwriting profit. But most insurance companies don't look at it that way, because they take those premiums, that money, and they go and invest that money, what Warren Buffett calls the float. And that can be billions, tens of billions of dollars. And that float then gets invested, and then they make the money on the investments from the float, and they don't really mind that they don't make an underwriting profit. Well, Chubb is different. Chubb is the best in the world, actually. Well, I don't know. That's a big statement. But Chubb makes underwriting profits, and it made another big underwriting profit there. And as long as you are under 100 on what they call the combined ratio, that means you're paying out less than those $100 that you bring in. I hope that kind of explains it. Their consolidated net premiums hit $14 billion in the quarter, dollars that is, and that was up by nearly 11%. Those are big numbers when you're in a low inflation environment. And furthermore, the pre-tax net investment income was a record $1.7 billion. So you've got your underwriting profit on the one side, but this pre-tax net investment income, in other words, the money, the float that came in, they made a record $1.7 billion from that investment income in the quarter. It's not all sunshine, though, as we've noted on BizNews.com earlier this week. Global geopolitics and market cycles are tricky beasts. Even Greenberg himself warns that war in the Middle East raises a specter of higher inflation and slower economic growth. We also have to look at the balance sheet impacts. Chubb's book value was unfavorably hit by after-tax net realized and unrealized losses of nearly $2 billion. Unrealized means it's mark to market. They haven't sold, so they don't take it in the cash, and that's in their investment portfolio. So they made a good return on the investment portfolio, but they've also got the investment portfolio's value has fallen by nearly $2 billion, mainly because of the impacts of their public fixed income portfolio after the changes in interest rates. There's also a very interesting strategic retreat happening here. The documents from Chubb show that portions of the property insurance market are softening rapidly. That means that insurers are reducing the premiums that they're asking from that sector of the market. But instead of chasing unprofitable market share, and this is where Chubb is in a league of its own, it actively reduced exposures in the major accounts and excess and surplus divisions. And I say in a league of its own because other players in the market want to get in there. They think that they can calculate things, and when there aren't that many losses in property, then they want to write more business there. Well, Chubb says, we've got our disciplines, that's what we stick to. And boy, I like being invested with a company that looks at it that way. Just like Capitec with their disciplines, Chubb is also a very disciplined operation. And it walked away from shared and layered property businesses that did not meet their very high pricing standards. And that's exactly why we hold Chubb in the portfolio. When the market gets undisciplined, Evan Greenberg exercises restraint. He's the son of the Greenberg from AIG, and it runs in the family. And many say in America, he's even better than his pops. Anyway, you accept a paper loss on a bond portfolio, knowing that the core underwriting machine is pristine. In other words, the business they're doing is super. Well, finally, for this episode of Boardroom Talk, where we have a look at stocks in our portfolio in the news, let's bring it back to South Africa and have a closer look at Remgro. There's been a flurry of announcements recently regarding Remgro's final exit from FirstRand. And according to Sen's announcements, issued today, and that followed up from one on the 11th of March. Remgro has now completely disposed of its remaining shareholding in FirstRand. Between early February and March the 10th, they sold just under 52 million FirstRand shares on the open market. That's through the JSE. Anyone could have bought them. It would have put a bit of a dampener on the FirstRand share price as well. And that was an aggregate consideration there of just under 5 billion Rand. And subsequent to that, they sold the absolute final tranche of nearly 40 million shares for another 3.5 billion Rand. So it's out. Now, this is a really interesting story. I recall right back in the beginning when Remgro decided to invest in FirstRand in the first place. And that was when it was established with Laurie Dippenaar, G.T. Ferreira, and Paul Harris, and they were building it up. And Remgro traded in its mining portfolio, which was a very good idea at the time, for financial services. So they became a big shareholder in FirstRand, and that's going back decades. But to understand why they've changed their minds, we need context. Remgro, which is the Rupert family's investment holding company, acquired the direct stake in FirstRand back in June 2020, following the unbundling of its interest in RMB Holdings, which is where the original investment was made. So RMB Holdings unbundled. So RMB Holdings was put together by Laurie, GT, and Paul. And RMB, Rand Merchant Bank, as it first was at the time, was created by Johann Rupert. He'd come back from the United States, where he'd worked at Lazard, which was a top investment stroke merchant bank there. And he started his own merchant bank in South Africa called Rand Merchant Bank. And that developed into RMB, and then RMB was put into the whole FirstRand group, and RMB Holdings was the holding company. And they were happily going along there, creating operations like Discovery and so on. But then in June 2020, after the departure of the founders of FirstRand, or the last of them, the decision was that they would then unbundle RMB Holdings, and the FirstRand shares in RMB Holdings, which was by far its largest constituent, were then given to the different areas, and then Remgro has now sold it down from after announcing back then, that's 6 years ago, that FirstRand was labeled as a non-core holding, and by June last year they'd sold that down from about 4% of the equity to 1.5%, and now they've just liquidated the rest. So it's all gone. But why would you sell a phenomenal asset like FirstRand? Well, as far as Remgro is concerned, it comes down to capital allocation and the perpetual curse of the investment holding company, something called the discount to net asset value. In other words, these assets that you've got on your book are worth a heck of a lot more than what the market is judging your company as being worth. And we see this all over the place. We see it with, for instance, the whole Naspers story. That's probably the best example of them all, where Naspers' shares in Tencent, when you translate them, if Naspers were to sell them all, it would get something like between 30 and 40% more in cash than the value that the market puts on those shares in the Naspers portfolio, that discount to net asset value. And it's something an investment holding company like Remgro has been battling for a long time. Historically, it trades at a massive discount to the sum of its part, but it's told us, the Remgro team have told us, they are going to unlock that value, and by selling liquid non-core assets like FirstRand, Johann Rupert and the CEO Jannie Durant are unlocking trapped value. The SENS announcement today explicitly states that the proceeds from these disposals, the most recent ones anyway, will be put into Remgro's strategic cash resources and managed in accordance with their capital allocation framework. When a heavily discounted holding company starts building a war chest of now 8.5 billion rand in cash, it brings optionality. They can pay down debt at the center, or they can fund growth in the stars that they hold 100% of, or the ones that aren't listed on the market, like Mediclinic. Remember that big Mediclinic deal that was done recently where Remgro split with its Swiss partner? It kept the South African Mediclinic, and the Swiss kept the operations that were over on that side. And it was I suppose must have been a happy kind of parting of the ways. Big bet by Remgro and by Mediclinic on South Africa. And the other one is CRVH, which is the broadband company. The other thing that they can do as well, which the market loves, is to buy back their own shares. And that's at a massive discount. Now, we've seen this happening in many corporations where the directors look at it and they say, but hang on a minute. We know that if you add up the value of the company that we are working in, it's worth 100, but the stock market shares are trading at 60 or 70. Now, surely the best investment we can make is to go and buy those shares at 70, knowing that we're buying a rand's worth of value for 70 cents. That's what Naspers has been doing now for a long time. And Remgro, it's got 8.5 billion rand in cash sitting there waiting to do exactly the same. But what is the so what for the BizNews tribe? Well, if you look at Capitec, Chubb, and Remgro, you see a master narrative of agility and capital discipline, and that's what we love. You don't want to make an investment as a retail investor, as a private investor in a company that's not disciplined. If you've got the discipline, they must look after your money for you. And in this case, with those three companies and the results that we're seeing today, they're certainly doing so. Capitec is proving that a bank can outgrow a tough credit cycle by pivoting aggressively into digital transactions and insurance. Chubb is proving that the best insurance companies are the ones willing to walk away from bad business. And Remgro is proving that legacy structures can evolve, turning non-core paper into hard cash, even if it is an old friend like FirstRand. And that drives shareholder value. There are risks, of course. Capitec's international lending needs tight management. And if they do go into the UK, that's going to be a big story as well. That's probably why we haven't heard too many rumors. And there's certainly been no announcement on that front. So just stick to where it is at the moment. It's probably one of those things that they're looking at and thinking about. But with Metro Bank having fallen or slipped up there, who's to say Capitec won't be the next one to really make the UK market wake up? Investec have done pretty well there. Why shouldn't there be another South African doing the same? Chubb is navigating a volatile bond market. We remember Discovery had a similar situation a few years ago, and just time sorted that out. And then Remgro needs to deploy its new cash pile wisely. And the best way it can do that, the investment markets would say, is by buying back its own shares at a discount. But as investors, these are the kinds of management teams that we want here at BizNews, stewarding our capital. They aren't hiding from bad news. They're managing it. Well, thank you for joining me on Boardroom Talk today. For more insights, deep dives, and the latest from our model portfolios, be sure to join us at biznews.com. Just remember that we do have a monthly webinar for BizNews Premium members where you can come, pose the questions, and get the latest on those stocks in our portfolios. And we monitor them closely. It's a big responsibility. And that's why we're in stocks like these that I've spoken about today. I'm Alec Hogg. Until the next time, keep thinking clearly and invest rationally.